In this chart, we are analyzing a simple yet powerful London session trading setup using the KEMA indicator as our main confirmation tool. The first key point to notice is the 7 a.m. GMT candle, which plays a crucial role in determining our directional bias for the day. As we can see, this particular candle opens and closes bullish above the red K-comma line, which indicates that momentum has shifted in favor of the buyers. This is our first confirmation that the market is likely to move higher during the target trading session. Right after identifying this bullish 7 a.m. candle, the next step is to look for the entry candle, which forms immediately after the 7 a.m. session open. The entry candle confirms that buyers are maintaining control, and this becomes the ideal point to open a long position. The open price at this time is clearly marked on the chart around 1.11358, and it serves as a baseline reference for measuring our pip movements. Moving forward through the chart, you can see how the market continues to push higher in alignment with the overall bullish momentum. The chart highlights that the price moves about 50 pips away from the open, confirming that the session has good volatility and follow-through. This 50-pip movement is a critical metric, as it helps traders set realistic intraday profit targets and stop-loss levels based on session volatility. The target market session, as shown in the chart, runs from 7 a.m. to 7 p.m. GMT, which aligns with the London and New York overlap, the most active period in the Forex market. This is when liquidity and price movements are typically at their strongest. You can see how the market gradually consolidates after the initial move and then resumes its bullish momentum, achieving a total difference of around 50 pips from the opening price by the end of the session. The red line in the middle of the chart represents the K-comma indicator, which acts as a dynamic trend filter. When candles consistently close above this line, it indicates that the trend is bullish, and traders should focus on buying opportunities. Conversely, if candles were closing below it, that would be a signal to look for selling positions. In this example, the consistent bullish closes above K-comma confirm that the uptrend remains strong throughout the session. Now, let's move to another powerful bullish setup, the bullish head and shoulders pattern. This is one of the most reliable reversal patterns used by professional traders to identify the end of a downtrend and the beginning of a new bullish phase. In this chart, we can see a clearly defined left shoulder, head and right shoulder formation, which together create the classic shape of this pattern. The market initially moves downward, forming the left shoulder, followed by a deeper decline that creates the head, the lowest point of the pattern. After that, price rises again but fails to break the previous high, forming the right shoulder. This structure tells us that the sellers are losing strength and buyers are gradually stepping back into control. The blue horizontal line drawn across the chart is called the neckline. This line connects the highs of the left shoulder and the right shoulder and acts as the key level of resistance. When the price breaks above this neckline with strong momentum, it confirms the bullish reversal. This breakout point is also the ideal buying zone, as marked on the chart with the label Buy Here. An important detail to notice is the increased volume that occurs right at the breakout. This is a very strong confirmation that buyers are participating in the move and that the breakout is genuine. Without volume support, a breakout can often be false. So this increase in volume adds confidence to our entry. After entering the trade, traders usually set their target projection by measuring the vertical distance from the head to the neckline and then projecting that same distance upward from the breakout point. This gives a realistic price target for the bullish move, as shown in the chart with the dotted arrow labeled Projected Target. As the pattern plays out, we can see how price steadily rises after the breakout, achieving the projected target and continuing the uptrend. This confirms the strength of the reversal and validates the accuracy of the bullish head and shoulders setup. Now let's look at another powerful example of how price action works when it aligns with key confluence levels. In this chart, we are analyzing a setup where multiple factors come together to give a high probability trading opportunity, a concept known as confluence in trading. You can see here that price had previously respected this red horizontal level multiple times in the past, acting as a strong resistance zone. Each time the market approached this area, sellers stepped in, pushing the price lower. This repeated reaction confirms that it's a level that market participants are watching closely. As price eventually breaks above that resistance, it begins to retest the same level as new support. This is a classic behavior in price action. Once resistance is broken, it often flips into support. When the price pulls back to retest that zone, it provides an excellent opportunity to look for bullish signals, and that's exactly what happens here. Notice how the chart highlights a pin bar candle that forms right at this confluence point. This pin bar appears at both the 50% retracement level and the key support zone, which makes it a highly reliable reversal signal. The long lower wick of the pin bar shows that buyers rejected lower prices and absorbed selling pressure, pushing the price back up before the candle closed. This type of reaction confirms that the market is respecting the support level and that buyers are stepping in with strength. After this pin bar forms, the price begins to move upward sharply, confirming the bullish reversal. The strong move that follows demonstrates how combining support-resistance analysis with candlestick confirmation can give traders a high-confidence entry point. Now let's move on to a more advanced concept: trading market structure using support and resistance levels. This chart gives us a clear example of how price reacts to key zones and how traders can use these levels to identify high-probability trades. In this setup, you can clearly see three major areas highlighted in blue, one at the top acting as resistance, one at the bottom acting as support, and the central zone where price consolidation occurs before a major breakout. Notice how price moved upward initially, forming a strong bullish structure that topped out near the upper resistance zone around the 1.44 thousand level. After failing to break above this zone multiple times, the market started to shift downward, indicating that sellers were beginning to take control. As the price continued to drop, it broke below a key horizontal level around 134,000, marked here by a black line. This breakout is significant because it represents a shift in market structure from bullish to bearish. The previous support level now becomes resistance, and this is where professional traders start to look for retest confirmations before entering short positions. After the breakout, the market pulls back toward that same level. This is the retest phase. The price retests the broken support, which now acts as resistance and fails to move above it. That failure confirms that sellers are in full control. This area is the perfect entry zone for a short trade, as it offers both confirmation and confluence with the previous structural level. The chart also highlights a retracement zone in yellow, representing the region where price temporarily corrected before continuing its downward trend. This area often aligns with Fibonacci retracement levels, such as 38.2% or 50%, giving additional technical confirmation for traders who combine price action with Fibonacci tools. Once the retest is complete, the market resumes its downtrend sharply, creating a clean bearish move that extends all the way to the lower blue support zone near the 1.23 thousand level. This massive drop demonstrates how powerful structure-based trading can be when combined with patience and proper confirmation. If you look closely, you'll also notice that every bearish move in this chart forms lower highs and lower lows, a classic characteristic of a strong downtrend. This reinforces the importance of reading the market structure and identifying when the trend has shifted. Rather than fighting the market, traders who align themselves with the new bearish direction can ride these major impulsive moves for significant profit potential. Now let's analyze another important concept: trendline confluence with key levels. This chart demonstrates how combining multiple confirmations, such as trend lines and horizontal zones, can provide a high-probability setup for both breakout and reversal trades. On the left side of the chart, you can see a clear downward channel formed by two major trend lines, labeled Trend Line 1 and Trend Line 2. These lines represent a controlled bearish movement where each lower high and lower low maintains the integrity of the downtrend. The market is moving in a structured way, respecting both trend lines until it reaches a major key level, shown here in blue. This blue zone represents a historical area of demand, a level where buyers have previously stepped in to push prices higher. When the price touches this zone again after a long bearish trend, traders begin to look for possible reversal signs or at least a short-term corrective move to the upside. This area becomes a point of interest for potential bullish setups. Now, shifting to the right side of the chart, we can see how the market begins to show early signs of recovery from this support level. The downward trend line is still intact, but price is starting to challenge it. Notice the resistance cluster formed along the red descending trend line. This area represents the combined resistance of both the trend line and horizontal price reactions. When such confluence occurs, it usually determines whether the trend will continue or reverse. Here's where the key decision zone appears, marked as IF breakout. This label suggests that if price breaks and closes above this red resistance cluster, it could trigger a trendline breakout, signaling a potential bullish reversal. Traders who follow trendline strategies often wait for this type of breakout confirmation before entering long trades. Below this structure, you can also see a support zone highlighted in blue. This area serves as a protective level where traders might set their stop losses if they decide to buy after a breakout. If the market fails to break above the resistance and instead drops back down, this blue zone would again act as a potential buy zone or a point to reassess the market structure. Now, let's move to another excellent example that demonstrates how trendline rejections and double-top patterns work together to signal potential market reversals. This setup is from the AUD-NZD pair, and it beautifully combines higher time-frame trendline analysis with lower time-frame confirmation. On the left side of the chart, we have the daily time frame, which shows the overall trend direction. You can clearly see that price has been moving upward within a rising structure until it finally touches the major trendline resistance, marked with the black line and the arrow pointing downward. This trend line has been respected multiple times in the past, making it a highly valid technical level. When the price reaches this resistance zone, we see a clear rejection candle forming. The wick extends upward, but the candle closes back below the trend line. This indicates that buyers attempted to push the market higher, but were met with strong selling pressure. It's a classic signal that momentum is starting to shift from bullish to bearish. Now, shifting to the right side of the chart, the 4-hour time frame, we can see what happens in more detail. The same rejection area from the daily chart is visible here, but now the structure becomes even clearer. Notice how the price forms a double-top pattern right around the trend line area. Each time price touches this resistance cluster, it fails to break above it, creating two distinct peaks shown with black arrows. This pattern confirms that the market is struggling to make new highs, and sellers are defending this level aggressively. The support line drawn beneath the double-top acts as the neckline. Once the price breaks below it, it confirms a short-term bearish reversal. Another important point here is the use of Bollinger Bands, which are displayed around the candles. The upper band shows price stretching to its volatility limit before reversing. The fact that both peaks of the double top touch the upper band adds further confirmation that the market was overextended and due for a correction. In addition, the pink moving average line in the middle of the Bollinger Bands acts as a dynamic resistance level. After the second rejection, you can see how price closes below this moving average, signaling that bearish momentum is increasing. This multi-time frame setup perfectly demonstrates how professional traders use confluence between trend lines, candlestick rejection, and double-top formations to time their entries with precision. The ideal strategy here would be to wait for the lower time frame break below the neckline and then take a short position with a stop loss above the recent highs. As price begins to move lower, the downtrend continues with clean bearish candles confirming the reversal. This approach, using the daily chart for trend direction and the 4-hour chart for confirmation, allows traders to enter trades with higher accuracy and lower risk. The key takeaway from this setup is simple. When multiple signals such as trendline rejection, double-top structure, and overextended Bollinger Bands align, it often signals a high-probability reversal zone. Combining higher time-frame context with lower time-frame confirmation is one of the most reliable ways to catch early reversals before the larger move develops. Now let's move on to another excellent example, this time on the NZD-JPY pair, showing how a clean multi-time frame rejection setup forms at a key resistance zone. This example perfectly illustrates how traders can use both the daily and 4-hour charts together to confirm high-probability reversals. On the left side of the chart, we have the daily time frame. You can clearly see that the price has been rising steadily until it reaches a major resistance area, highlighted by the green zone at the top. This zone has acted as a strong supply area in the past, meaning sellers have previously entered the market here and pushed prices down. When price returns to this level again, we immediately look for signs of rejection. Notice the black arrow marking the candle that touches the top of this green zone. This candle has a long upper wick and a small body, a classic sign of seller rejection. It shows that although buyers tried to push the price higher, they were overwhelmed by sellers at this level, leading to a sharp downward close. This is our first clue that a potential reversal might be forming. Now moving to the right side of the chart, we zoom into the 4-hour time frame to confirm this setup in more detail. Here we can see that price not only touches the same resistance zone, but also forms a clear lower high structure, marked again with a black arrow. This means that buyers were unable to reach the previous high, confirming a loss of bullish momentum. You can also see how the Bollinger Bands wrap around the candles. The price reaches the upper band near the resistance zone, signaling an overextended move. When price fails to sustain that upper band breakout and instead closes back inside the bands, it often signals the beginning of a short-term reversal. Additionally, the pink moving average line, the middle of the Bollinger Bands, acts as a dynamic resistance level. Once the price drops below this line after rejection from the upper band, it confirms that momentum is shifting to the downside. The market structure becomes even clearer when price breaks below the minor support level, shown with the small horizontal line under the arrow. This break is the trigger for a potential short setup, confirming that sellers have fully taken control. Traders can now look for short entries with stop losses placed above the resistance zone. The key takeaway from this example is how powerful it is to combine higher time frame levels with lower time frame confirmation. The daily chart gives you the big picture, identifying key resistance and supply zones, while the 4-hour chart helps fine-tune the entry point through clear rejection and structure breaks. This kind of multi-time frame confluence is what separates professional price-action traders from beginners. By waiting for both higher-level rejection and lower-level confirmation, traders can increase their win rate while keeping risk to a minimum.